Give me 12 minutes and I'll show you how 8 ETFs can quietly build the kind of portfolio most people only dream about. One that could have already made you a millionaire if you'd started a decade ago with just a few $100 a month. I know, that sounds like one of those internet get-rich-quick pitches. But this is the exact opposite. Because here's the uncomfortable truth. Over 70% of individual stocks underperform the market long-term. And most people, without realizing it, are building their entire retirement on stocks they barely understand, hoping for a win instead of engineering one. This video is about choosing a different path. It's called the Forever-8 Millionaire Map, a simple portfolio strategy built around 8 of the best ETFs on the market, not because they're trendy, but because they've stood the test of time, minimized risk, and offered real returns. This is about freedom versus the retirement roulette most people are unknowingly playing. Disclaimer: this video is for educational purposes only and is not financial advice. Investing involves risk, including loss of principal. Yields and distributions can change, and past performance does not guarantee future results. And if you stay with me, I'll show you one ETF near the end. ETF number 7. That's surprisingly under the radar but has quietly outperformed many hyped-up growth stocks, and why it deserves a place in your long-term plan. And if you're between 25 and 50 and tired of guessing games with your future, you're in the right place. Let's get into it. Let's fix the biggest buy and hold mistake. Let's be real. Most people who say they're buying and holding are just guessing. They hear a stock tip from a friend or see a TikTok video hyping some company they've never heard of, and they throw in a few $100. And then they forget about it until it crashes. This isn't a strategy, it's just passive gambling. Here's where people mess this up. They buy and hold stocks that were never meant to be held forever. Most individual stocks, even big-name ones, don't outperform the market over time. In fact, over 90% of individual stocks fail to beat a simple low-cost index fund. And worse, many lose money altogether. Think about that. You could be spending decades investing and still underperform someone who just bought a single ETF and forgot about it. This is why I say, you don't build freedom with guesses. You build it with baskets. ETFs are that basket. They hold dozens, sometimes hundreds or thousands of companies. So one bad pick doesn't tank your future. Here's a simple bit of math. A $500 monthly investment earning 5% per year grows to around $200,000 in 30 years. But if it earns 10%, it more than doubles to over $1.1 million. That's the difference between random bets and structured baskets. So here's the shift I want you to make today. Your default is ETF baskets, not single stock bets. In the next 60 seconds, I'll break down ETFs in plain English, and why they're quietly winning while so many investors are stuck playing stock market roulette. Let's clear the confusion. Here's how ETFs actually work. Let's clean the slate. You've probably heard terms like ETF, mutual fund, index fund. Maybe you even own some, but most people couldn't explain the difference if their 401k depended on it. And that's okay. You're about to learn more in the next minute than most people do in years. Here's the short version. An ETF, or exchange-traded fund, is a basket of stocks that trades like a regular stock. You can buy or sell it at any time during the trading day, and it usually comes with extremely low fees. A mutual fund is also a basket, but it only trades once per day, usually comes with higher fees, and is often locked to one provider like Fidelity or Vanguard. That's why your 401k often forces you into a limited menu, because that's how the brokerage makes money. Myth: mutual funds are what serious long-term investors use. Fact: a lot of people are just paying more fees for the same market exposure they could have gotten cheaper through an ETF. Here's a quick comparison. Box 1. A single stock equals one company. Box 2. A mutual fund equals a basket but with strings attached. Box 3. An ETF equals a basket but with freedom and lower costs. For example, the average actively managed mutual fund charges around 0.50 to 1% annually in fees. Many ETFs charge 0.03 to 0.10%. That's a massive difference when you're investing over decades. So here's your action. Commit to building wealth with low-cost ETFs, not high-fee complexity. Coming up next, I'll show you the 3 ETFs that form the absolute spine of my own Forever portfolio. These are the ones I'd still own even if I had to start from scratch. Now let's build your financial backbone. Starting with these 3. If you're building a Forever portfolio, Your foundation needs to be solid, and that means starting with the core layer. But here's the problem. Most people think they're diversified, but they're actually just holding the same handful of mega cap stocks over and over. Apple, Microsoft, Google, they're great companies, but they dominate most index funds more than people realize. Here's where people mess this up. They own 3 different funds that are actually the same top 10 stocks in disguise. So let's fix that with a smarter structure. I call it the core layer, and it's built using 3 different views of the US market. First, VTI. This one gives you exposure to nearly the entire US stock market. We're talking over 3,500 companies, large, mid, and small cap. If you want the broadest brushstroke possible, this is it. Next, VOO. It tracks the S&P 500, which includes the 500 largest, most stable companies in the country. It's the go-to benchmark for US market performance and one of the most popular ETFs out there. And finally, RSP. Same S&P 500, but with a twist. It's equally weighted. That means every company has the same impact, whether it's Apple or a lesser-known industrial firm. No single stock can hijack your returns. It's diversification done right. All 3 have incredible long-term track records. Over the past 10 years, they've all averaged roughly 10 to 12% annually, depending on the timing. And the fees? VTI and VOO both charge just 0.03%. That's $3 a year for every $10,000 you invest. RSP is a little higher at 0.20%, but still extremely low. Here's a quick math check. On $100,000 invested over 30 years, the difference between 0.2% and 0.03% could cost you over $15,000 in unnecessary fees. Money you could have reinvested instead. So here's your next step. Choose which of these will be your primary core, and which ones will be your supporting angles. Some people go 70% VTI and sprinkle in VOO or RSP. Others blend them evenly. Just pick your base and build on it with confidence. In the next chapter, we're going to bolt on ETFs that actually pay you to hold them, so your portfolio works for you even when the market's down. Now let's add reliable income to your portfolio. Let's be honest, it's easy to feel like the market is just a roller coaster of hype and crashes. But if you've ever owned an investment that pays you month after month, no matter what the headlines say, you know it hits different. That's where the cash flow layer comes in. See, when your portfolio is only based on price growth, it's tempting to panic during a dip. No income, no anchor. That's why I like to carve out a portion specifically for dividend-paying ETFs. First is SCHD, the Schwab US Dividend Equity ETF. It's laser-focused on high-quality U.S. companies that have been consistently paying dividends for years. These aren't shaky high-yield traps. They're solid businesses with strong balance sheets. Then there's VIGI, Vanguard's International Dividend Appreciation ETF. It brings global diversification to the mix by investing in companies outside the U.S. that have a proven track record of growing their dividends. Think global giants like Nestlé, Novo Nordisk, and Sony. Now, let's talk numbers. SCHD has offered a yield around 3.5%, with a total return in the ballpark of 11% annually over 10 years. VGI sits a bit lower on yield, closer to 2.5%, but offers that international exposure that cushions you when the U.S. market stumbles. Myth: dividends are just a tax headache. Fact: dividends, especially when reinvested, have made up as much as 40% of total market returns over the last 90 years. They aren't a side feature. They're a compounding engine. Now imagine this. You reinvest dividends for 20 years, never touching them. And then suddenly those monthly ETF payouts are covering your rent, your groceries, maybe even your vacations. That's not fantasy, that's math. So here's your action. Decide what percent of your portfolio you want in reliable dividend payers. Some go 20%, others 30% or more. The point is, don't ignore income. Build it into your strategy. Next up is where the serious upside potential lies. We're talking tech and innovation. The growth slice that can pull your whole average higher if you don't overdo it. Here's how to invest in tech without going full casino. Let's talk about tech, because this is where most portfolios either explode in a good way or implode. And it's usually not because of the tech itself. It's because of how people use it. Some folks avoid it entirely, thinking it's too risky. Others YOLO into it after seeing a headline. Nvidia's up 200%, Apple's releasing something new, Tesla just did something weird again. Either way, emotion leads, and that's a problem. Here's the mistake. Treating QQQ like a savings account. It's a growth engine, not your emergency fund. So let's build a growth layer that plays offense but does it with a strategy. First, QQQ. This ETF tracks the NASDAQ 100, which means you're getting exposure to the 100 largest non-financial companies on the NASDAQ. That includes mega cap innovation across tech, consumer, and healthcare. Names like Apple, Microsoft, Amazon, Nvidia, and Tesla. It's aggressive but not wild. Then we've got VGT, the Vanguard Information Technology ETF. This one is even more laser-focused. It's all about US tech, from system software to semiconductors to cloud infrastructure. Think Oracle, Adobe, Salesforce, the digital backbone of the economy. Now, the numbers don't lie. Over the past 10 years, QQQ has averaged about 18% per year, and VGT has done even better, pushing 20% annually in some stretches. That's massive. But here's the flip side. During downturns, these ETFs can drop 30% to 40% without blinking. That's why this layer should be capped. For most people, 15% to 25% of your total portfolio in growth is the sweet spot. It gives your portfolio lift without wrecking your confidence during a crash. Here's some mini math. If your core portfolio is earning 9% and your growth slice, paying, say, 20% of it, averages 13%, that lift can drag your whole average return up by 1 to 2 percentage points. That's a game changer over 30 years. So here's your move. Pick your growth band, 15%, 20%, maybe 25%, and stick with it through the ups and downs. No emotion, no headlines. And in the next 90 seconds, I'll show you one hyper-focused ETF that's quietly crushed it during the AI and chip boom, and why it should probably never be more than a small slice of your portfolio. Small slice adds big power, but only if you cap it. Every portfolio has room for a little firepower, but if you're not careful, firepower becomes flamethrower. That's why I keep a tiny focus layer, a small allocation for powerful trends that have long-term tailwinds but need tight risk controls. And right now, one of the strongest trends on the planet is semiconductors. Enter SMH, the VanEck Semiconductor ETF. This fund is packed with companies that literally power the modern world. AI, cloud computing, smartphones, electric vehicles, data centers, none of it works without chips. SMH holds names like Nvidia, AMD, ASML, TSMC, and Broadcom, the companies making the picks and shovels in today's digital gold rush. Now, this ETF isn't for the faint of heart. It's cyclical, it's volatile, but historically, it's been a monster performer. Over the past decade, SMH has returned more than 24% per year, outperforming almost every other major ETF. But here's the thing. Don't do this with SMH. Don't make it 40% of your portfolio just because you saw a chip stock moon on social media. This should be 5% to 10% max. That's enough to lift your overall return without exposing you to wild swings. Mini math. If a 5% slice of your portfolio earns 18% annually, that small position can still move the needle, without blowing things up when the sector drops 30% in a year. So take this as your final tactical piece. VGI already gave us some international balance, but SMH gives you precision growth, focused, volatile, and best handled with care. Now that you've seen all 8 ETFs, I'll show you the actual Forever-8 Millionaire Map, a dead simple allocation you can sketch in 2 minutes and use for the next 2 decades. Let's map it out. Here's how to pull everything together. So now you've seen all 8 ETFs. But here's the truth. Just owning good ETFs isn't a plan. It's organized confusion unless you know how to structure them. That's where the Forever-8 Millionaire Map comes in. This is the exact 4-layer system I use to build long-term wealth. Quietly, consistently, and with total clarity. Here's the breakdown. Core layer, VTI, VOO, and RSP. This is your market backbone. Broad, stable, and proven. Cash flow layer, SCHD and VIGI. These are your income engines, adding psychological stability and long-term dividend power. Growth layer, QQQ and VGT. This slice gives you access to innovation and high upside trends. Focus layer, SMH. A tiny but powerful slice riding one of the biggest megatrends. Semiconductors. Now let's bring it to life. Imagine you invest $500 a month into this setup. At a 9% average return, that grows to around $850,000 in 30 years. At 10%, it's over $1 million. No trading, no guessing. Just sticking with a plan that makes sense. And this isn't a get-rich-quick setup. This is a get-rich-sure. If you actually stay the course setup. Here's your action. Write down your percentages across each layer. Assign each ETF to its layer, and decide your auto contribution, even if it's just $50 a month to start. You can take it conservative, balanced, or aggressive. Conservative, heavier on core and cash flow, lighter on growth and focus. Balanced, 40% core, 25% cash flow, 25% growth, 10% focus. Aggressive, more growth, but still capping focus at 10%. Now picture this. You actually follow through. You automate, reinvest, ignore the noise. And in 25 years, you're looking at a 7-figure portfolio that pays you monthly. Now picture the alternative. It's 20 years from now, and you're still second-guessing random stock picks with nothing to show for it. And which version feels worse? You get to decide right now. Before you go, here's your 10-minute wealth move. Let's lock this in. Because if you've watched this far, you're serious. But seriousness only matters if it turns into action. Here's your 10-minute assignment for tonight. Open your broker app. Doesn't matter which one. Look up all 8 ETFs. VTI, VOO, RSP, SCHD, VIGI, QQQ, VGT, SMH. Pick your percentages, core/cash flow/growth/focus. Set one auto invest for next month, even if it's just $50. Comment below with your plan to make it real. Here's your one-line recap. 8 ETFs, 4 layers, 1 job. Quietly compound your money while you live your life. If this video helped you finally clarify your forever portfolio, hit the like button and subscribe to this channel for more calm, data-backed ETF breakdowns without the noise, hype, or hot takes.